Welcome to It's the Economy, the big economy event. The US Fed raises rates by 25 basis points to 5.25 to 5.5. This is the highest level in 22 years. The last time we saw rates at 5.5, it was in 2001. Chairman Jerome Powell stresses on a data-driven approach henceforth and therefore leaves the door open for a hike or a hold in the September meeting. Remember, there's no August meeting. You only have a Jackson Hole meet. Rob Subbaraman, the head global macro research at Nomura, and Jahangir Aziz, global head EM economics at JP Morgan, joins us now, both from different continents. Jahangir has stayed up for us, Rob, so with your permission, let me go to him. Jahangir, well, Powell said could hike, could not hike in September. What's your sense of the hike cycle hereafter?
So, I mean, as you laid it out, I think, the FOMC was, hawkish with the hike by itself. I think it kept the door open by saying the room for further firming of rates. But I think it was the press conference after the FOMC meeting where I think there was the tilt towards the more dovish side coming from Powell himself. And, when he was asked the question about, whether he is in line with the two rate hikes that is still in the SEP, he sort of backed away from it and said that, well, it's going to be data dependent. And between now and September, you have at least two more non-farm payrolls, two more CPI, one ECI. And so he did not really say that he is married to the two hikes that is still there in the SEP. So I would say that, September is very data dependent. And I think that, that the way we are looking at it is that we are probably this is going to be the last hike and that we are going to be on pause for a long period of time.
Okay, and very quickly, what is your view on bond yields in dollar index? Dollar index has actually dipped from 101 to 100 after the announcement.
I think in the case of the 10-year bond, I think it is much more to do now with not with how high the 10-year will go. I mean, it did go down by about 6 bips after the speech, but I think it is much more to do with the slope. I think there has been a steepening that has taken place, and my sense is that if the Fed remains on hold in September, our view is that the yield curve will steepen further from here onwards, which is probably in line with the fact that even the Fed staff has now taken away the recession that they had and have replaced that with a very, sharp slowdown. So I think that's on the yield curve. I think the dollar is a bit more messy. I think if you go from here onwards, if you look at the PMI numbers that came out this week, the manufacturing PMI in Europe looks really, really bad. Whereas, in the case of the US, not only did the manufacturing PMI lift up, which we were expecting, that's also the case with Japan. So I think what happens to dollar euro depends very much on what we see happening in Europe. And I think by the looks of it, I think the growth differential between US and Europe is going to widen in favor of US, which means that there's likely to be dollar strength. And given that, the Fed is going to be on pause, the question now boils down to whether the ECB go for another 25 basis points of rate hike or not. And the same with a Bank of Japan, whether they will actually widen the YCC band, which we will get to know this week. But by and large, I think that there is, the way we're looking at it is that there is modest dollar strength going forward, given where, these two economies stand and where US ECB rate differentials will likely evolve in the next 6 months.
Okay, yeah. So basically, the chances of a dollar index increase. Rob, how would an emerging market central banker now look at it? Say, for instance, Reserve Bank. Would the reading be that clearly the Fed is more or less on pause or at best a hike? How would, say, an RBI read this?
I think the reading of it by EM central banks right now is that the Fed is pretty close to done in its hiking cycle, but still very data dependent. So I think a good base case is the Fed is probably done, if not just one more hike. And then for, I think, emerging markets where inflation is also coming down, some possibly could start cutting rates. But I think, Latha, the thing that's really throwing a spanner in the works for emerging markets right now is commodity prices, which are starting to rise quite sharply, particularly in India, food prices. And that feeds into the CPI inflation in emerging markets a lot more and a lot faster than in developed markets. One of the simple reasons is the weights in the CPI basket for food items and energy items are much larger. And so I think one challenge for the Reserve Bank of India is in the coming months, headline inflation could rise very sharply, perhaps over 6%, whereas core inflation stays fairly low. And so I think even if the Fed is done raising rates, I think we're entering an environment, especially if commodity prices keep going up, where EM central banks, including the RBI, are going to have to sound hawkish.
Are going to sound hawkish. Okay, I was actually going to ask you if you're advancing your expectation of a rate cut from Reserve Bank. Not so.
Yeah, we're strongly thinking now. We had been expecting the RBI to cut rates before the end of this year, but given with what's happening in commodity prices, we are reevaluating that, and the risk is we will be pushing out the timing of when the RBI starts rate cuts.
Okay, let me concentrate on growth for a minute. Jahangir, post that 2004-2008 hikes, when you stopped with Lehman, there was a long period of slowdown. This time, does the US and the world get away with much less growth slowdown?
Look, I mean, that's clearly the biggest question. And again, the jury is out on that. We are seeing a reasonably large disinflation taking place. And if you look at the disinflation taking place, it is taking place with labor markets tight across the globe, particularly in DM. So it is not that the wage growth is coming off or service sector growth is faltering. And that's the reason we are seeing this slowdown in core inflation. The slowdown in core inflation is coming from the fact that supply chains are normalizing. And there, I think we need to look at China and the spillover that we were expecting from China. We were thinking of the spillover taking place because of the reopening on growth, but the spillover did not take place on growth. Instead, the spillover is taking place on the inflation side. If you look at supply chains, manufacturing supply chains particularly, those have normalized, prices have come down. If you look at Chinese export prices, Chinese export prices are now -7, -8 at this point in time. So there's a lot of disinflation coming from that normalization of supply chain in China that is being passed on, and and the rest of the world is benefiting from it. And I think this is going to continue. So I think part of the decline in inflation that is taking place because of the supply chain normalization, which has very little to do with growth. I think once that situation gets sort of normalized, so we get to a point where, let's say, in the case of the US, we are at the 3.5 level, right? Core inflation. That's when I think that the labor market, the domestic economy will start mattering, and that the jury is out at this point in time.
Okay, now, if that's the case, the growth is not going to slow down that much. Then, Rob, are you upping any of the growth forecasts, including for India, as far as Asia EMs are concerned? Growth not slowing down much, and actually a disinflation in the form of core out of China.
No, I'd say at this stage we're keeping our growth forecasts as they are. I think, as Jahangir has said, I think it's very uncertain in terms of the growth outlook. I think I can see kind of two-way risks right now. If you look at the US, for instance, lending conditions continue to tighten. We are seeing some early cracks in the labour market, but the key labour market indicators are still pretty good, but there are cracks. And the housing market seems to have regained some vigour. So it's kind of mixed. What we do know is monetary policy works with lags. And so it's still quite possible that we get growth slowing down, even though I think markets are starting to move away from concerns of a recession in the US. I think it's still possible. And so, I think we have to keep an open mind on the growth outlook right now, as do policymakers. Here in Asia, we're very focused on China. As Chandra mentioned, China growth is very weak, and it is exporting some disinflation right now. The hope is there is going to be more policy stimulus coming through for China. And if that happens, that could be an important support for the rest of Asia. But, we've been waiting for that for a long time. So I think the jury's still out. The proof will be in the pudding. And I don't think we're not planning to really revise any of our growth forecasts up at this stage until we see the stimulus for China. And on the other side, as I talked earlier, if commodity prices keep going up, that's not good for Asia. Asia is a large net importer generally of commodities. So that could become more of a headwind.
Okay, Rob, a very quick view on India. India is not that dependent on Chinese growth and in fact may benefit from the disinflation that both of you are talking about. So is there a chance that you can, revise up India growth forecasts?
As I said, for us at Nomura at this stage, I think we're maybe on the lower side for growth. For FY24, we're forecasting 5.5% growth for India. And we're reasonably comfortable with that right now. I think, there is, in our view, some headwinds for the economy. One is monetary policy has been tightened. And I think the second one that is starting to build is around the rise in commodity prices, which the outlook is very uncertain. So, at this stage, we're quite comfortable sitting on 5.5% growth for FY24.
Okay. Well, that does make you the lowest among the analysts we speak with. But yes, let's wait and see how things pan out. We will get the first GDP number on August 31st. Rob, Subbaraman, Jahangir, thank you very much indeed for spending time with us, parsing the FOMC moves and more importantly, giving us a picture of the Asia and the Indian growth story. Wrap up on Bazaar on that note. Markets still fairly cheerful, but off the morning highs, chartbusters will take the action forward.